Welcome to Pro News Weekly. Let's dive into the weekly updates on the financial markets. The US dollar methodically gained ground over the week. The DXY rose for 6 consecutive sessions, gaining 1.3% on the back of macroeconomic data. Neutral inflation readings provided the latest leg of gains. Consumer prices rose in line with average forecasts, a 2.7% increase overall, and a 3.3% rise when excluding food and energy. Markets reasoned that this would not prevent a Fed rate cut next week. At the same time, expectations of aggressive rate cuts are fading in the outlook for next year, which is what drives markets most. In addition to a strong labor market, producer prices also have an impact. The PPI growth rate has risen to 3%, the highest since February 2023. Core inflation, at 3.4% year over year, is accelerating through 2024. Policymakers and investors are also spooked by the uncertainty over the risks of renewed trade wars, which is shaping inflation risks. However, these risks are still too uncertain to influence central bank officials and move markets, although the topic has not left the front pages of the financial media. The technical picture suggests that the dollar has turned to growth after a 2-week correction. As the advance continues, the focus will be on the momentum of the DXY around the 108 level, where highs were made at the end of last month. If the dollar can overcome this resistance, we can expect a breakout to the late 2022 highs around 113. These could be tough times not only for emerging markets, but also for equity markets. The dollar's rise in the final week of the year weighed on the Dow Jones and Russell 2000 indices, which fell 2.8% and 4.8% respectively from their recent highs. However, the NASDAQ 100 was boosted by the success of the high-tech giants. The index approached 21,800, moving further into all-time high territory. This kind of divergence is not sustainable. This means that in the next week or two, we will either see an acceleration in the Russell and Dow or a correction in the S&P 500 and NASDAQ 100. A stronger dollar seems to point towards the second scenario, but everything could shift depending on what the Fed says. The Swiss National Bank cut its key interest rate by 50 points to 0.5%, a bigger move than markets had expected. In Switzerland, however, low inflation has pushed rates back down near zero. The consumer price index slowed to 0.6% year over year, the lowest since 2021. USD/CHF gained 0.8% on the back of a deeper than expected rate cut. The pair has risen more than 5% since the end of September, driven by the global strength of the US dollar. The strength of the franc is evident in the crosses. CAD/CHF has been repeatedly supported by dips below 0.620, an all-time low, while Euro/CHF is only 50 pips above sustained historical lows. Active traders may want to watch the Euro/CHF if it falls below 0.9250, as further rate hikes are possible. A reversal of the multi-year trend can only be discussed if the pair consolidates above 0.9450 to 0.950. The crypto market cap jumped to $3.71 trillion at its peak on Wednesday. Optimism in the U.S. stock market pushed Bitcoin above $100,000, bringing buyers back into altcoins. The cryptocurrency sentiment index returned to extreme greed territory at 83. Bitcoin climbed just above $101,500, meeting solid resistance for the past 7 days. Current levels are above the psychologically important round level and the consolidation area of the last 3 weeks. It may be risky to talk about a breakout to new highs and a complete eradication of bearish sentiment. A confirmation of buying strength could see a quick rally into the $120,000 area. Ethereum rose 7% on Thursday to $3,900, doubling Bitcoin's performance. However, This is a rally and not a breakout to new highs, which makes the path easier. It will be interesting to watch the price action as it enters the $4,100 area. From this level, there are roughly equal chances of a sharp reversal to the downside and a break of resistance with a flight to the $5,000 area. The new week may serve as the market's final crescendo before a gentle lull sets in for the remainder of the year. Meanwhile, the significance of the latest batch of macroeconomic data cannot be overstated. Monday's preliminary PMI business activity estimates for Europe offer the last chance for the region to end the year on a positive note. November's data was a disappointment, sending Euro-USD below 1.05 at one point and showing an acceleration in the decline of business activity in the Eurozone. The ECB is taking a cautious approach to rate cuts, but the weak data has seen the euro fall against the dollar as traders are pricing in 4 ECB rate cuts over the next 6 months versus 2 or 3 for the Fed. On Tuesday, U.S. retail sales and industrial production figures will be released. While retail sales have risen smoothly without causing concern, the industrial production index has fallen in 3 out of the last 4 months. At the same time, Canadian inflation data will be released. It has stabilized at 2%, but there could be surprises. CAD weakness creates upside risks, while the economic slowdown creates downside risks. On Wednesday evening, all eyes will be on the Fed. A 25-point rate cut is a foregone conclusion. The main trigger will be the Fed's forecast of its next steps and its assessment of the economic outlook. This event has the highest potential for volatility and could set the trend for the following weeks. On Thursday, the Bank of England's key interest rate will be in focus. Analysts expect the central bank, which has decided to cut rates every other meeting, to hold off on easing this time. However, we see the potential for volatility in the event of an unexpected cut. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.